Hello and welcome to the Money Show, your one-stop destination for all your personal finance queries. I am Kavita Thapliyal and we have lined up a power pack show, and here's what you should expect on the show today. First up, we will discuss how you can protect your portfolio from uncertainties in the market. We will be joined by Kushal Lodha, founder KAGR. Next, if you are someone who is looking to invest for your grandchildren, then we will help you find the best ways to do it. We'll be joined by Harsh Rungta, founder Fee Only Investment Advisors LLP. Next, we will analyze how SEBI's order to execution only platform will impact mutual fund investors. We'll be joined by Pankaj Matpal, MD, Optima Money Managers, and then we will discuss if this is the time to go heavy on gold investments, given that the US Fed has opted for a pause in rate hikes. We'll be joined by Kunal Shah, Head Research, Nirmal Bang. And finally, on our last leg, we'll drop on the counter to get your mutual fund portfolio queries answered by Pankaj Matpal. So do send us your queries on our WhatsApp number, which is 8657974571. You can also email us your queries on themoneyshow@etnow.tv. So that's the lineup for the day, but then let's get you the top headlines of the hour. Nifty recovers over 170 points off day's low to close above 18,800 mark. Mid-cap index continues the winning run for 7th consecutive session. PM Modi en route for his first 3-day state visit to the United States. Defense technology transfer and supply chains will likely be the top agenda in bilateral talks with President Biden. Modi also likely to meet Tesla chief Elon Musk. All truck cabins to mandatorily have air conditioning from 2025, says Union Transport Minister Nitin Gadkari. Adds that manufacturers need 18 months to upgrade. Aviation Minister Jyotiraditya Sindhya hails Indigo's mega order for 500 Airbus jets, says the order speaks to potential of India's aviation sector. Hilton's country head Navjeet Ahluwalia says hospitality chain hopes to have 200 properties in India by 2030, throws light on growing demand in India. It's an ET Now exclusive. Centre to send teams from IMD, Health Ministry and Disaster Management to areas with prevailing heat wave condition. Health Minister to assess situation Telangana, Odisha and other states tomorrow. Alright, so let's begin. And well-managed investments can grow your wealth over time and help secure your financial future. But all investments carry risk, and a key goal of your investment portfolio should be to minimize overall risk while simultaneously maximizing your investment returns. So let's welcome on board Kushal Lodha, founder KAGR. Understand how can you protect your portfolio from uncertainties. And Kushal, good evening and welcome to the show. Well, the best way to protect your portfolio from uncertainty is to have a very well diversified strategy. But then having said that, a lot of people don't understand what does actual diversification mean, and what they actually do is maybe just diversify themselves very well under one asset class. Now what happens is when you talk about uncertainties, and when I want to understand these uncertainties which are associated with different asset classes, what exactly do we mean by that? There are uncertain environment in the markets, and investment instruments that are not related to the market also have uncertainties. So what kind of risks are we talking about here, Kushal?
Sure. Thank you so much, Kavita, for having me. It's an absolute honor to be a part of this. Just answering to the question here, right? I mean, asset allocation in terms of diversification doesn't necessarily mean that you need to be diversified when you're investing in equities. By diversification, what we mean is that you need to have a very good portfolio in terms of investing in equities, bonds, mutual funds, index funds, and even gold. Like, for example, yesterday we have got to know that sovereign gold bond has been issued. And not only that, even in terms of real estate investment trust, both the commercial as well as the residential, they have been booming a lot. So by that, what I mean is that every person, every individual should allocate a certain amount of wealth to each of these asset classes, asset portfolios. And for a person like me who's 24 years old right now, most of the proportion would get into equities and certain proportions would get into gold, mutual funds, index funds, etc. So that is something which we mean by asset allocation and diversification. And talking about risks, I think rightly mentioned, right? I mean, a lot of these uncertainties are going around where, let's say, the US Fed is hiking the interest rates. And apart from that, we're also having a lot of other uncertainties in terms of the stock market expectations. So a lot of these black swan events are coming into the place. And the best way to hedge for all these uncertainties is by diversification, firstly. Second is correct asset allocation in terms of proportion. And thirdly is by using some strategies in terms of covered calls or put options as well, if you are into trading of futures and options.
Exactly. What about the fixed income instruments and the uncertainties and risks attached with that?
Right. So talking about fixed income instruments, right? I mean, the only challenge here is that nowadays, especially in India, right? I mean, retail investors investing in bonds, that has not become very widely common phenomenon as it is there in other countries. So, for example, people are very much inclined to investing in equities, but they don't understand the benefits of investing in bonds. And there are like less platforms of investing in bonds as compared to investing in equities as well. Like few of the ones which come to the top of my mind are like Golden Pie, Altify, etc. But like the risks and challenges over there are that if let's say a corporate is issuing like let's say a double A or maybe a B grade bond, or like there are ratings of the bonds. So that kind of risk is associated with all the kinds of bonds where let's say the default rate, maybe the yields are higher, but the default rate are also higher in that case. However, in my opinion, a person who is let's say just about to begin his or her investing journey, they should ideally allocate 15 to 20% of their portfolio to bonds as well, given the fact that they're going to get a fixed percentage rate of return as well. Now, even if let's say you talk about the market uncertainties where you don't even know that whether you're going to get good returns in Nifty or Sensex, etc., it's a good way of hedging your portfolio where you're at least going to get some sort of return. If let's say not 15-20%, but at least let's say around 8% or 7% in case of AAA rated bonds. So that is something which I usually advise. And I think there are a lot of different companies, of course, without naming any one of them, but a lot of different companies have started issuing their corporate bonds, and you can just go on the websites and you can like try to analyze basis certain factors, which are the ratings of the company, the duration of the portfolio, duration of the bond, and apart from that, like how much maturity proceeds you're expecting once you redeem the bond.
All right. But when we talk about portfolio and we talk about the diversification strategy across asset classes, how does this balance actually strike off, when we talk about uncertainties? The uncertainties attached with different investment instruments, all of them won't appear at the same period of time, right? Could
Right.
you explain the kind of balancing act that the diversified portfolio can actually help you with mitigating your uncertainties and the risk?
Sure, absolutely. So that's a great question, according to me. So see, like let's take an example. Okay, so now I was talking about index funds. There are a lot of index funds as well where they have a bunch of stocks under their radar, and then if you invest in these index funds, automatically you are diversified because they are already investing in a bunch of stocks and not one stock. For example, even if you talk about international investing, like taking an example of let's say N100 or the Nasdaq 100, which is an index fund where you can invest in today as well. Now, this is a collection of the top 100 listed companies of the US which are listed on NASDAQ. If there's any uncertainty in the Indian economy, you are still safeguarded, or you are hedged. You have hedged your portfolio because you are investing in the top 100 tech stocks of the United States. And if you see the past returns also, you'll be surprised to know that the N100 has given like a 1 year KAGR is 43%. Of course, like this is an outlier. But if you talk about the 3 year, 7 year, and 10 year KAGR also, it has given around 20 to 22%. The point of stating this is that there are certain instruments which will definitely hedge you whenever there is an uncertainty in your particular country or your economy. That's one. Number two way of, let's say, hedging your portfolio here would be, let's say, diversifying your own wealth into different asset classes. For example, if let's say now there's a very decline in the stock markets, you can definitely invest in sovereign gold bonds. And as you know that the correlation between gold and equities has been negatively correlated over the last few years. That's a proven phenomenon. So having a diversification portfolio of negative correlation asset classes will definitely help you if there's an uncertainty in one particular area or in one particular market. So if the equities are going down, you have already hedged and you are buying gold, and the appreciation in gold will definitely fetch you some sort of capital appreciation. And talking about sovereign gold bonds, you're already getting 2.5% per annum interest rate on a half yearly basis as well. So the advantage of sovereign gold bonds is again that you are investing in them and the exempts and the capital gains is exempt if you are redeeming it at the end of 8 years, which is the lock-in, which is the maturity proceeds. So that is another appreciation or another benefit. And in the past few years, if you see the gold returns, like on an average, 8 to 10% has been the yield for gold bonds. And that is going to continue for the next few years as well, in my opinion. So this is the best way of diversifying, where let's say if there's a problem in one particular asset class, you are hedged and your other particular asset class is definitely giving you some sort of returns.
Kushal, I think that's the word coming from you. Thank you so much for being on the show today and helping our viewers with uncertainties across asset classes. How can you mitigate all of that in your portfolio? But then